That is on.
Hello?
Yeah, that's on. That's
Oh,
on. That's
okay.
on.
And then
Don't hold. Yeah, just tap it for red or green. Yep.
okay. Perfect.
I just don't know.
I think we should pass it out like once there's more people. Or am I like tripping? I don't know. Hey. take it back.
I have the idea of a plan as a wise man would say.
Good afternoon. If everybody could take a seat, we're going to get started here in just a couple of seconds. All right, thank you, everybody. Glad everybody could join us for the first ISM of this spring semester. We have a little bit of good news to share, and then I'm going to go ahead and turn the reins over to the students because that's why we're here. First, I would like to bring Vu on down. Where's Vu? Come on down, Vu. Let's give Vu a round of applause. He's our first national champion for this competition because we would like to see if we can get some more. And you can see that we have a really cool trophy now to add to our trophy case. For those of you that don't know, the Team Challenge is a ETF portfolio management competition. And this is a competition that had more than 600 different students from a wide range of top-notch universities involved. And we've competed before in the past. We've not ever even put a student in the top 10. This year, Chandler finished 8th, and of course, Vu took home the trophy. So I'm just very thrilled that that we're getting more competitive in this competition. And I just want to give a huge round of applause one more time for Vu for his enormous accomplishment. Thank you. All right, moving on. For those of you that don't know, we're going to have a legacy gala. So for some of you, this is probably an event you might want to find out more information about. If you are interested in going, you can email me. I can get you the QR code. Make sure that this is going to have a lot of different folks getting some awards, especially probably some folks that y'all know in town that deserve different awards for things they're doing. But I wanted to highlight one of our own. The very first Young Alumni Achievement Award is going to go to Ben Cheatham. And if you know Ben, you know that he deserves this. He works at JP Morgan, does not only does he do a lot for them, but he to Chicago. Ben takes him out, mentors them, and also picks up the tab for us. And if you know Ben, you know that he's not only is he highly successful, but he's a man of high integrity too. And so I just wanted to highlight that for those of you that might be interested. We will have a Smile Fund, one of our own, getting acknowledged at that event as well. All right. So that would move us on to some big announcements for the actual Smile Fund. First thing I wanted to say is we normally Universal Joint right after this for a free networking event. I'm going to have to pull an audible because Universal Joint told me that they're down a few employees and they also have another event there. Don't worry, you're going to get your free food. You're just going to have to go a little bit further for it. And it's probably going to cost me even more, but we're going to go to Odd Story on Central, the one that's more on South Side, not over here on MLK, but Odd Story down on Central. And so if you can get out there, it's going to be a lot of fun. And everything is picked up except for the alcohol. And it's a very good networking event. And it's an opportunity that we hope even some of our community members go and get to meet a lot of these awesome young men and women. All right. So the last thing I'd like to say is this is kind of a special ISM as well. One of our students has been president of the Smile Fund for a good long time. He's been on the CFA team, and he's done just about everything you can do in the Smile Fund, including some of the hard stuff, the VP of market analysis. He's always been there, and he's one of those students that I know I'm going to have a very strong relationship with for the rest of my life. And when we say Smile Fund for life, this is the type of relationship we're talking about. It's been a privilege and an honor to have Caden in the Smile Fund. And for the last time, take it away.
Smile Fund for life. Just to start before we get any further, as he said a little nicer than me, but my reign of terror is over after today. So we're going to have Dylan come up and he will present the 2026 performance, as well as any future looking questions will be addressed to him as well. My whole job is basically to just go over 2025's performance, as well as any thought processes that came from that. All right, so let's get started. See, we've got a couple big that were crossed in 2025. The main one being, there it is, $4 million in total assets under management. The traditional fund also crossed $2 million, which represents 53.3% of total assets under management. The strategic fund crossed 800,000, representing 20% flat. And all of the style funds have crossed 300,000, with the core fund crossing 400,000. All of these represent roughly, give or take, about 8.7% if you average them all out. It's important to note that if we wanted to start from the beginning with the total assets under management of January 1st, 2025, the traditional fund's up about $700,000. The strategic's up about 150. Growth is up 75. Core is up 150, and the value is up 75 as well. So let's move on to total performance. We see that we ended the year in 2025 underperforming by 10 basis points. And year to date, we are underperforming by 1.4%. As we all know, earnings season has been a little rough, and it's been doubly rough for the fund. But long term, we're not too worried about this. It's just a volatile time. Since inception, the fund has returned negative 28.6% compared to the benchmark. And on an annualized basis, that comes out to about 80 basis points of underperformance. Now, let's talk about the style funds in a little more detail. We see that the growth fund was able to pull itself out of a pretty tough slump, leaving the year at 6.7% of outperformance. And year to date, they're also up 4%. This is primarily caused by Vertiv, which was a holding that we'll talk about more. But Isaac and now the current growth PM have really held strong in that, and it's paid dividends for them. Moving on to core.
Have y'all seen what happened to Vertiv today?
Like 25%?
Yeah, 25% today too. So it's working out still.
Moving on to core, a similar story happened, especially over the summer, as we can see. They had a pretty strong deviation away from the benchmark and really pulled through in quarter four, leaving 2025 with 11.5% of outperformance. And year to date, they're doing even better at 12%. And finally, we see value has also had a very good run in quarter four of 9.1% in 2025, and they're also slightly up at 1.5% year to date. Now, let's look at our top performers and our bottom performers. It kind of gets to that point where I could throw up all the rectangles and talk about each of them, but I do really just want to highlight one main story on this slide, which is the fact that all of these have a very high average overweight compared to the benchmark, with the minimum being 2.5% in HICO. I've said it at pretty much every ISM, but main strengths of the Smile Fund comes from our commitment and our confidence in our quality research. And this is clearly evidenced in our top performers. Moving on to bottom performers, I'm going to exclude Micron, Palantir, and General Electric for this. Not that these are not ones that we should consider, but Palantir, we currently own a equal weighting. Actually, we've increased it since Dylan's Trader Quest. He'll talk more about that later. Micron is a good lesson in the fact that if you were at the last ISM, you would know that we actually presented on Micron. And it wasn't a bottom performer then. So it's interesting to see how strong they were at the end of quarter four. And General Electric just had some really interesting things throughout the year, and they kind of snuck up on us as well. But the main story here is two critical lessons that the fund has had to learn over and over again. And that comes from one, Vertiv, which I know we have a lot of new faces in here. At the beginning of 2025, we monstrous position in Vertiv. I think at one point it was about almost 8%. And if you guys know, DeepSeek came out, wiped out like $1 trillion from the total S&P market cap and sentiment in the market. Obviously, that was short-lived. I don't even think anybody uses DeepSeek in here. But I, in that time, decided to increase our position in Vertiv because I thought it was unfounded. There's really not a lot of big issues with that. Unfortunately, I realized I didn't have the stomach for it. And about 2 months later, the stock dropped about 40%. As such, I, to a degree, panic sold at the bottom, and it has been a constant burden on performance in 2025. Another big lesson here is Salesforce. We need to work out a process, and I know Dylan's done a great job of this, is building out a process on identifying losers. While the thesis on Salesforce hadn't technically degraded, it was clearly something that needed to just be removed, or at least trimmed sooner than when I made my final trade request in December. So graphically, our
Hey,
performance.
Caden, let me explain something real quick too. So, for those of you that don't know, we have several different accounts. We have, in terms of bottom up, we have a traditional fund and 3 style accounts, and we still hold Vertiv in the growth fund, and it has done fantastic. Um, as you can see, we've actually outperformed in all 3 style accounts, and if you combine all of the funds together, we outperformed as well. But we mainly look at the traditional fund in terms of performance today. So, just wanted to kind of give you some context there.
So let's take a peek at this graphically. I'm going to go over the 5 trade requests I made in 2025. So obviously we mentioned the one in Vertiv. This happened like January 21st, if I remember, was the day DeepSeek went out. And that same day I made a trade request. Unfortunately, with the CFA and also just me realizing I didn't have the stomach for it, I panic sold at the bottom. The decision to sell here actually led to a very good decision. Some might call it steal or skill. I would call it luck. That being, we decided to hold about 3% of the cash, which, if we know anything about Liberation Day, ended up being a very good decision for the fund. Obviously, we can see down at that spike, we were at one point outperforming by about 2 or 3%. Unfortunately, we were at Game Forum at the time, and by the time we came back, Trump had reversed the tariffs. So that giant spike basically cost us most of our outperformance. So I made a trade right when we got back, and that ended up just taking that cash and throwing it into the benchmark until we found better research opportunities. Fast forward to summer break, obviously I didn't make a trade. So we tended to deviate from the benchmark, which was quickly corrected in September with that quality of earnings trade that I talked about. That would have been HCA, Apple, and Shopify, which did very well and ended up closing the gap in Q4. And before I left, I snuck in one final trade, which was Danaher, which you're going to see as our stock report today. These are going to be really quick. These are just some themes that I noticed throughout the year that are fun to keep an eye on, especially the PMs as we move forward. So to start, I believe that capital efficiency, at least in the tech space, is beginning to break down. It's looking like every dollar of CapEx is now generating about half the revenue it used to. There's a chance that if this continues, it could lead to a fundamental productivity problem. Personally, I also believe that we're watching a $400 to $500 billion AI infrastructure bet play out in real time. Revenue growth has stuck at historical levels since COVID, but spending has doubled. If we don't translate to real revenue in the next few quarters, there's a chance that the AI investment thesis is going to get questioned. In fact, we are starting to see some questioning happen, especially in the, I forget the exact sector, but we are definitely seeing it in our big AI stocks. And finally, with all this CapEx spend, it does set up a margin squeeze. When you're spending at twice your growth rate, depreciation hits, interest costs can pile up, and operating expenses rise. There's a chance that we're looking at a 200 to 400 basis point increase of potential margin compression if revenue does not catch up. Now, a big mitigant here is obviously going to be CapEx spending now is meant for future growth. So obviously, while we are seeing a big deviation currently, we should expect to see, hopefully, revenue catch up in the coming years. And finally, this is an interesting chart. I'm just going to talk about it and the process behind it. I just took the S&P 500 weighted versus the equal weighted S&P 500, based the returns and divided them by each other to get this graph. All that's saying is that if it goes up, we're seeing unwinding. So we're seeing concentration decrease. And if it goes down, we're seeing increased concentration. So throughout the year, we saw a general trend downwards towards concentration. Obviously, we've heard about Mag 7 and how big they're becoming in the fund. And we've seen a very quick reversal coming back. If this continues, we do need to decide if this is a, how would I put it? I think I might have it here, actually. I believe, yes, right here. We need to decide if such a large movement represents something such as institutional rebalancing or systematic deleveraging. So it's just something we need to keep in mind moving forward, especially with the PMs. Now I'm going to hand this over to Dylan, and he's going to go over his trade request and other things.
Can I get a round of applause for Caden? Thank you, Caden, and our now official president of the Small Fund, Dylan.
Good afternoon, everyone. My name is Dylan DeHart, and I'll be serving as the incoming president of the fund. I'm really excited for this opportunity and really, really happy to continue driving our performance and our strategy moving forward. Today, my presentation is relatively brief. I'm going to walk you through the recent trade request I made, as well as my thoughts behind it. So on February 2nd, we instituted quite a large trade request within the traditional fund as part of a broader 2-phase plan that I have. Phase 1, which is now largely focuses on our realignment through strategically streamlining the portfolio by exiting our smaller and less impactful positions moving forward, which should allow us to increase our focus on our current holdings. Second, phase 2, which is an ongoing process, centers around return optimization. We will now be looking at strategically reallocating our capital into our highest conviction holdings, opportunities that are non-benchmark or non-benchmark heavyweight opportunities to continue driving growth moving forward. You may ask why. Well, over the past year, we've watched as the style funds actively employ a concentrated allocation to our highest conviction holdings, a methodology that has largely allowed them all to outperform the benchmark over the life of the funds. And having served as the PM of the value fund throughout 2025, I saw the value, no pun intended, in this approach and would like to lean into it within the traditional fund. So in the trade request last week, we exited 12 positions, each under 2% of the portfolio. These smaller positions were sold for various reasons, from being immaterial, like American Tower Corp, at just 0.7% of the portfolio, to changing convictions, such as NextEra Energy and Tractor Supply, or as a result of negative performance and continuing headwinds in the case of Salesforce. I believe that this capital can be better allocated to our higher conviction holdings to materially drive returns forward looking. Second, to ensure that this continues to be a theme, I've implemented a new rule where new positions must have a minimum of a 2.5% weighting to hopefully allow us to concentrate our capital where we have the highest conviction and can drive returns moving forward. Yes, sir.
And just a quick announcement, because we are live streaming this, for anybody can ask questions, the community members, not the students, but any community member can ask any question. Students will let you ask them afterward, the ISM, but please use the microphone so it gets picked up. Thank you.
You exited 12, so how many positions remain?
We dropped from 35 holdings down to 26.
Okay. The 2.5% minimum, what does the policy say? We have minimum and maximums, I thought. We have maximum.
We have maximum. So the maximum is we're allowed to buy into up to 10%. And if it runs up to 15%, we have to trim back to that 10% weighting. Currently, nothing is the highest allocation across the entire fund is only at about 7.5%. But there's no relative minimums. It's just from a portfolio management philosophy, having holdings at 0.7% of the portfolio that are somewhat unfollowed.
No, I don't have any issue with what you did. I just wanted to make sure it's not a violation of policy.
Oh, fantastic question. Thank you. Alrighty, looking at my second phase of the trade request. On this slide, you'll see that after selling all those things, we had some excess capital. We bought 3 new holdings and increased 6 existing positions. Our new positions target high conviction opportunities beyond benchmark heavyweights, where we have strong long-term confidence. The remaining funds were used to increase weight in core positions, a short-term action as we work to gather credible and detailed research before the next trade request and steps of phase 2. It is worth noting that this materially increased our allocation to consumer staples, adding earnings stability and durability, while also selectively increasing communication services to capture secular growth and the improving monetization as the AI theme matures. Overall, the objective was to refine our positions, eliminate our smallest low conviction holdings, and prepare the portfolio for new research so we can deploy our capital into non-benchmark high conviction opportunities. Thank you. I will now open the floor for questions. No questions? Well, thank you guys very much. I'll now welcome Thaddeus up.
Hello, everyone. I'm Thaddeus Weiss. For those of you that were at the last ISM, I promise I won't have another 30-minute presentation, but I'm the current VP of Market Analysis, and today I'll be presenting my update on the current macroeconomic view of the U.S. market. Just to start off with what I'll be discussing, talking about the current changes that are going to happen in the Fed going through this year, ranging from personnel shifts to entire policy stance shifts. Then I'll talk about how some of our big indicators are actually dictating, after a year of uncertainty, a softer landing period of expansion. Then I'll cover a few macro tailwinds that I think should be defining factors for the fund's portfolio moving forward through this year. To start off with Fed policy, after multiple rate cuts in the second half of 2025, the Fed seems to have entered into a phase of dovish patience, where they kind of seem to be waiting to see what the implications of their recent policy or their interest rate policy have been before they make any more sudden moves. In addition, the Fed's dual mandate between inflation and unemployment kind of seems to be shifting more towards unemployment than it has been in the past, after it had been focused on inflation that had remained elevated for a few years. As we all know, the labor market has been struggling, and it's not, detrimental to the economy yet. But if it continues to struggle and slow, or if layoffs become more frequent or just massive in terms of size, we'll likely see more aggressive rate cuts by the Fed. And then lastly, I wanted to touch on the new Fed chair that will be coming on May 15th. His name is Kevin Warsh. He's a former member of the Federal Reserve Board of Governors. The market is pricing in multiple rate cuts after his term begins in the middle of this year. And we'll have to see how his stance goes on QE. He's kind of been a critic of the liquidity strategies that are conducted usually through quantitative easing, and the market is kind of expecting him to be more in favor of using interest rates as the primary tool for growth. Moving on, I'd like to discuss some of our indicators and what they're doing right now. I'll start off with GDP. After a sluggish first half of 2025, we actually saw a big bounce back in GDP growth in the third and projected in the fourth quarters of 2025. The majority of that growth actually came from a massive bounce back in consumer spending, mostly due to the One Big Beautiful Bill Act's tax cuts, and there's no longer taxes on tips and overtime, which has helped the bottom 80% of consumers surge in spending. But also, the majority of this growth in consumer spending came from high-earning households, which have a favorable tax and policy environment right now, which should help consumer spending contribute greatly to GDP growth as we move further into 2026. In addition, government spending kind of saw a slight drag towards the end of 2025 due to the federal shutdown and everything. But with the One Big Beautiful Bill Act spending set to kind of really start ticking up through the first half of this year, I'm projecting that government spending should become a more significant contributor to GDP growth, with possibly as much as 0.5% quarter over quarter headline growth coming from government spending as billions of dollars in fiscal impulses are injected into the economy. Then lastly, I wanted to cover how net exports is holding a strong position as a contributor to GDP growth. We saw that through the second half of 2025, again with quarter four being projected. Mostly this is due to imports greatly falling, and it just seems like reshoring due to tariffs is starting to slowly but steadily actually occur, which is a good sign for future net exports and the trade balance in terms of contributions to GDP growth. But also record exports of crude oil, natural gas, liquid natural gas, and precious metals have kind of fueled that surge in net exports. And I think that these are all things that are going to be subsidized kind of through expansionary fiscal policy this year. And especially with the weakening dollar amount in terms of the precious metals as well, it's something that is likely to continue. Moving on, I'd like to discuss the current state of inflation. So as you all know, inflation and unemployment are kind of being held at relatively high levels. But we do have some decent news for these indicators. So energy price growth as a component of inflation has actually slowed significantly. This is providing kind of a downward critical pull on overall CPI. It is worth noting that in terms of components of energy price growth, electricity is still seeing fast price growth, mainly due to the AI-driven supply shortage and kind of demand exceeding supply currently. But other than that, other energy commodities and gasoline are actually seeing price growth slowing, which is, again, providing a downward pull on CPI. And services sector's price growth is actually beginning to slow. And this has kind of been the heart of sticky inflation for a while now. They're slowing mainly due to a combination of AI automation and increased productivity, as well as slower consumer spending on services, many of which are discretionary. And again, this kind of is a major downward pressure on the overall level of CPI growth. But I believe that those two first trends are kind of, for the time being, going to be counteracted by the pass-through effects of tariffs reaching their peak of potency through the first two quarters of 2026. It's kind of like an echo effect there, where as firms are beginning to run out of that pre-tariff inventory, we're likely going to see the biggest impacts of those tariffs on the actual level of prices starting now and towards the middle of this year. And that's kind of why you see for most of the projections that I've pulled from Bloomberg, that's why you see a little bit of an uptick towards the middle of this year before slight decreases towards the end of this year. Moving on to unemployment. Again, we all know the labor market's been struggling and that unemployment has been held at kind of an elevated rate. But one thing that I kind of thought was interesting when I was digging through this data is that the peak of unemployment in kind of the second half of 2025 seemed like it was largely, not completely, but a major driver of it was re-entrance into the labor force, likely due to people trying to take advantage of the One Big Beautiful Bill Act's tax cuts on tips and overtime. So re-entrance into the labor force, which currently there are low hiring rates. So those people that are re-entering into the labor force are unemployed for longer than they would desire to be, obviously. But that's contributing significantly to the overall level of unemployment. But also the permanent number of job losers the number of permanent job losers has drifted up slightly towards the end of 2025 and the beginning of 2026. It's still not at recessionary or contractionary levels, but it does reflect a struggling labor market, especially in sectors such as retail and manufacturing, which are heavily impacted by tariff-related COGS increases and AI automation. But the current makeup of unemployment from job losers is about 27%, which again is not healthy with like the Goldilocks level of where we would like to be for a healthy expanding economy, but it's not at recessionary levels. We're kind of in a unique spot right now in the economy where we're at like a low hire, low fire place for firms. It seems like U.S. firms are kind of hoarding the talent that they have, especially in the higher skill positions, and they're being hesitant to let off large numbers of those high skill employees as well as bring in new ones. And to me, I believe that this could kind of signify that there's some uncertainty still in the short to midterm for the U.S. economy. And that is kind of reflected also by our current yield curve. So we have currently what's called a J curve. And although the U.S. yield curve has de-inverted, it is not to the point where it's in a completely healthy upward sloping state. So it's the steepest towards the end that it's been since 2021, but midterm securities are still experiencing lower yields than short-term securities. And again, that just seems to kind of be indicating that investors and, well, firms from the last slide, but also investors as well are kind of hesitant about the short to midterm state of the economy. There's still a little bit of uncertainty, likely related to factors such as tariffs, increasing geopolitical tensions, elevated states of inflation and unemployment for the time being, and then also possibly even like the dollar weakening could be another factor that's contributing to that. In addition, I wanted to discuss kind of is this one? Okay, there we go. Okay, so I also wanted to discuss how with a yield curve that's becoming more and more steep, it is possible that some of these tech stocks, growth stocks, and cyclical stocks, which are considered high risk and are becoming increasingly more priced at a premium, they're going to have to compete with these relatively risk-free long-term securities that now have fairly healthy yields. And I'm interested to see how that's going to affect the demand for the demand from investors and how willing they are to pay, increasing premiums for another dollar of EPS. Lastly,
I'm sorry, I don't follow. I don't follow anything. What you're talking about. I mean, I'm trying to follow it, but I'm thinking, what does the steepness of the yield curve have to do with value earnings of tech companies?
What I was trying to convey is that I think if investors can secure like a low risk yield of, on a long-term security here, it would be about 5%. I'm interested to see if they'll choose that lower risk investment over these tech stocks and growth stocks and cyclical stocks that are becoming more and more high risk as they're kind of, priced at a premium by the market, if that makes sense. That's kind of what I'm trying to lead into. Yeah. It's from what it's an algorithm that Bloomberg uses. It's based on what investors are expecting, is what I gathered from when I read the description. But it was one of the largest contributors on the BICO function. And I tried to grab the 4 largest for each of these indicators to kind of just show differing projections. They could be. I'll look into that a little more deeply and get back to you. Okay. Yeah.
For argument's sake, the market.
I think that the market is priced in 2 rate cuts in the second half of this year after Kevin Warsh comes into office. Yeah.
If the market's saying that inflation's going to understand what the market implied. Trying to understand your thesis.
I think that the Fed is going to kind of be how I was talking about. They're in kind of a phase of patience right now. I don't think they're going to be as aggressive as we had thought, projecting forward last year. I'm interested to see how long this kind of focus on increasing liquidity and supporting growth lasts. I believe moving towards the middle of this year and through at least the third quarter, that's going to be what the main focus of the Fed is. But if these new policies and these rate adjustments do have kind of more whipsaw effects than they'd think, and we do lean towards projections of inflation that are on the higher end, I think the Fed would, not hesitate to kind of pull back that strategy that they have of promoting growth, and again shift more heavily back towards trying to put a cap on where inflation and price growth actually gets to. And then the last thing I wanted to touch on this slide, I wanted to kind of highlight that it's projected still that these longer term yields on long term securities are going to rise a little bit more as investors continue to demand compensation for increased budget deficits, as well as inflation that's remaining at elevated levels. Now, I'll cover a couple of macro tailwinds factors moving forward as in terms of how we allocate our portfolio through this year. So the One Big Beautiful Bill Act was designed to favor companies that build, earn, and grow all within U.S. borders. Firms that are especially capital intensive, development intensive, and R&D intensive are going to be major benefits of the tax cuts that are involved in this bill. And so to me, I think that that's going to create good opportunities for growth within the defense and aerospace, industrials and manufacturing, and materials industries. In addition, legacy fuels and nuclear energy are going to be beneficiaries of this bill due to decreased incentives for firms to develop green energy, green infrastructure, electric vehicles, and things that had been subsidized by previous that had experienced subsidized growth from previous bills and legislations. In addition, the agricultural industries are actually getting a good bit of subsidized demand through this bill. And I believe that there's a very niche cross-sectoral avenue for growth there that the fund should explore. In addition, the Tax Cuts and Job Act's individual provisions should help those bottom 80% of household earners that kind of feel a little bit of a pinch right now through the natural kind of stimulus and increased disposable income that they'll have through increased refunds and lower taxes. I believe that a lot of that spending, when they do receive it, is going to go towards consumer staples, as consumer sentiment is not in a great state right now, and it's been kind of it hasn't been falling consistently, but it has been falling most releases for a while now. And I believe that because of that, because the majority of consumers are not feeling great about where they are right now, I think a lot of that new spending from that stimulus is going to be directed towards consumer staples. So I think that that's also another winning sector from this legislation. And then lastly, this bill kind of inherently is going to make firms that were experiencing subsidized growth before and firms that rely heavily on cross-border supply chains and things like that, those are going to be some losers. So international and multinational firms, as well as social spending beneficiaries, mostly concentrated in like the healthcare services sector. But healthcare is a little bit more nuanced, and I'll touch on that in a minute. And then again, clean energy, clean infrastructure, and electric vehicles are going to be all losers from this legislation. Moving on, I'd like to touch on one last trend, which is what I like to call the AI productivity paradox. So 2026 is expected to be the year that we begin to see a mass transition from AI being a CapEx focused thing to actually implementation being the new story. It's going to become a necessary component of corporate infrastructure. This increase in productivity and efficiency should benefit nearly every sector. And there's going to be significant indirect beneficiaries such as industrials, materials, healthcare, financials, energy. A lot of these other sectors are going to experience growth due to this implementation. The market is shifting its focus from AI shovel stocks to efficiency and productivity, now centering the story on cost cutting and margin expansion for these companies that are actually going to be able to use AI as a tool to increase profitability. Moving on, I want to show kind of my top-down, forward-looking dashboard for how I think the fund should allocate. I don't believe it was really that contrary, because we're both focusing on the idea that AI is going to be more focused on implementation now, and sectors are going to be using it as a tool to increase the efficiency of their own operations and their profitability to help drive margin expansion. That's what I was gathering. I thought we had kind of.
Provided a little. It's not going to line up perfectly with what Thaddeus has as well, but the overarching theme for both of us is about the same.
Okay, because you use the term loss of capital efficiency, right? In other words, not very productive capex right now in the space.
Right now, yes, and I listed it as a mitigant later is the fact that capex spend now is ideally should have revenue growth in the future, which is what we're seeing here.
All right.
So I guess it's because you changed colors. So on the left, you're modeling out 20% growth in AI services related revenue. That corresponds with that over there.
Yeah, sorry, I didn't even realize that I'd switched colors there. But yeah, I pulled this data from Bloomberg Intelligence's function. They had projections for the growth for AI related revenue versus capex, and then the actual numbers as well. And as we can see, although both are projected to grow in the future, it looks like actual revenue generated from the implementation of AI is going to be the main driver of kind of that area of growth in the stock market.
$1.8 trillion.
That's what I had seen from Bloomberg.
Interesting.
Okay. So, I'm sorry.
What?
So I'm assuming that was a big market basket of large firms. It could be the entire S&P, but it is multiple firms that are cross-sector. And then the growth rate for CapEx is just from the actual hyperscalers, so the big ones. Yeah, I'll kind of touch on that in just 1 second. Did you have a question as well? No. Okay. Okay. Moving on to my sector recommendation dashboard. So this is going to be my top-down as well as bottom-up forward-looking projection. There's a couple of sectors that I wanted to touch on specifically, and then I'll address questions about other ones, but I didn't want to take the time to go over each sector individually. But I wanted to start off by addressing the fact that consumer discretionary is I'm recommending that we hold it at market weight. and I want to up our weight in consumer staples. It's because we have kind of a unique environment right now in terms of tax policy and legislations in general that are affecting different cohorts of consumers differently. So as we saw earlier, consumer spending has surged since quarter three of 2025, and that's been mostly driven by higher income households. And I don't think that the environment that is benefiting them from the current administration is going to change enough to justify projected slowdown in spending from those higher income households. So I believe that luxury sub industries and even with rates falling and expected to fall, durable goods, luxury brands may be able to perform very well. And I think that that justifies at least a market weight for consumer discretionary if we're able to overweight those sub industries. Now, on the other hand, consumer staples, I had discussed how the One Big Beautiful Bill Act should kind of act as a function of relief for some of these, the bottom 80% of households that are feeling a little bit of a pinch right now. And I believe that that stimulus is going to be directed towards consumer staples because consumer sentiment is not in the best area that it's been in right now. Another sector that I wanted to touch on that I thought was very interesting and I wanted to explain more in depth because I feel like I hadn't been able to touch on it yet was REITs. I think that there's some very interesting sub industries within REITs that the fund should explore for investment opportunities. Namely, I'm looking at healthcare REITs that serve the aging population and increased need for more senior living and healthcare services for seniors. And then I'm also looking at REITs that have large portfolios within the natural gas, liquid natural gas, and other legacy fuels areas that are going to be able to benefit from this subsidized growth for those sectors from OBA, the One Big Beautiful Bill Act. And then I also, again, REITs also have the AI infrastructure and the adjacent related kinds of REITs that are still going to experience growth as AI is continued to be developed and implemented. So I will come back to this slide for questions because I'm sure I'll have some about the other sectors. But I just wanted to recap what I touched on during this presentation. We talked about how with new personnel joining in mid-2026, and even before that new personnel was announced, the Fed is expected to have kind of a shift from a slightly restrictive policy stance to more of a neutral stance, with a potential in the short term renewed focus on promoting job creation rather than solely focusing, not solely, but mostly focusing on inflation, which is what they'd had to do for the last couple of years. And then despite sticky inflation and persistent unemployment, we have some relatively positive compared to last year outlooks for some of our major indicators. And that's helping some of these concerns of economic contraction begin to subside with actually very positive and robust growth projections moving forward. And then the One Big Beautiful Bill Act, the J-shaped yield curve, and AI implementation pivot kind of being three factors that I believe should define how our portfolio is allocated going through this year. And with that, I will open the floor to questions.
Going back to slide 23, right there with the winners, losers.
23. Oh, okay. There we go. Oh, sorry. Okay.
Why are you saying that Medicaid and SNAP are consumer discretionary? They are the very base levels and the minimum levels of healthcare and food for families that are low income, which is contrary to what you were saying about what the bill is supposed to do about pinching these families, the 80% of the low that are feeling really harsh. Don't know that I would put them consumer discretionary because they're safety net kind of programs. I don't know that eating dinner is a discretionary. But kind of curious what your thought is here, because are they going to be helped or are they going to lose?
So I have to address, I took out that's in like a copied from Excel, so it's an image. And last night I changed the border around it and I saw that I had written discretionary there instead of staples. So that was an accident. That was a typo on my part, so I apologize for that.
So you expect that the bill will actually help these consumers at the very lowest of the 80?
So I do, overall, because I think there's kind of differing tailwinds happening here. But I think despite these specific government programs that provide kind of those provisions for those industries being cut, I think the natural stimulus that we see from the tax cuts, as well as increased refunds, are going to provide at least a temporary kind of that impact should overshadow the actual cut of Medicaid. And I believe that because consumers, again, are feeling the bottom 80% is feeling like they're in a pinch, I think that spending is going to go mostly towards consumer staples. And does that make sense? Okay. Do I have any more questions? All right. Thank you so much. With that, I will hand it off to Bana.
Good afternoon, everyone. My name is Bana Suleiman, and I'm the new VP of Risk Management. Today, I'll be presenting the risks for the Smile Fund's portfolio with a focus on the traditional fund. To start off, in 2025, we underperformed by 12 basis points compared to the S&P 500. At year-end, our portfolio beta was 0.02 higher than the benchmark, while for the year, our average beta was 0.98. We have successfully positioned our portfolio to take on slightly more market exposure, exactly in line with our president's goal of increasing beta on a bullish outlook. On a risk-adjusted basis, we remain aligned with the benchmark, posting a trainer ratio of 0.14, indicating no excess return or loss. Now let's look into where this negative 0.12 underperformance came from. In 2025, IT had a return of 24% in the benchmark, while over the course of the year, we had a relative underweight of 2%, combined with a negative selection effect due to holdings like Salesforce, F5, and T-Mobile, leading to an overall attribution of negative 2.31%. On the other hand, we had fantastic selection effects in healthcare and financials, driven by our HCA and Morgan Stanley holdings, as Kaden noted earlier. Our top 10 holdings comprise approximately 56% of the traditional fund, including 4 positions outside of the S&P 500, like Walmart, Raytheon, T-Mobile, and Morgan Stanley. All of these holdings but Raytheon have delivered positive relative returns. And as of February 4th, 2025, our top 10 holdings have outperformed by 31 basis points relative to the benchmark. Looking at the bigger picture of our top 10 holdings in the entire fund, by ending weight year to date, 4 of these holdings reside in the S&P 500, but fall outside as top 10 holdings. They represent combined positions across our overall fund, targeting undervalued opportunities beyond the mega cap leaders. Overall, our top 10 holdings make up about 48% of our portfolio weight. Having established the impact of our top 10 holdings, let's examine how our sector allocations stack up against the benchmark. First, we hold 0 allocation to energy, real estate, and materials. Trimming these lowest conviction areas, as Dylan previously discussed, avoiding the benchmark's combined 8% exposure. We maintain underweight positions in IT, consumer discretionary, and industrials. Conversely, we are overweight in financials, communication services, and consumer staples. Moving forward, we will continue to refine these holdings as markets evolve. Last semester, we researched 50 stocks, and across the individual equity portfolios, we have 38 holdings, as you can see on your handout. As time goes on, we will expand into small cap research to increase diversification beyond our core positions. I'm also excited to announce that our style funds are looking into some new research, with HPE in the IT sector for value, American Express in financials for core, and AMD in IT for growth, ensuring a pipeline of ideas that extends our traditional focus. Now let's discuss the main risks to performance. First of all, magnified concentration correlations. Our top 10 holdings are fairly concentrated, representing 56% of the portfolio, thus exceeding the S&P's 500 top 10 at 39%. And our increased volatility. Portfolio beta rose from an average of 0.98 in 2025 to 1.13 currently year to date. This is due to more concentrated positions in higher beta names. We are more concentrated now based on our bullish stance on the market and our research. Lastly, our valuation sensitivity. The markets expect a low margin of error, as we have seen in recent earnings calls. For instance, in the case of a group of major tech giants like Microsoft, Meta, and Amazon, which are projected to spend a combined total of $715 billion on AI this year, which is 60% more compared to last year. These risks are real, but we have clear mitigants in place. Going forward, we will expand our research on mid-cap and value stocks, and analyze lesser known names. Second of all, portfolio weightings are being aligned with favorable macroeconomic conditions. And we are working closely with our VP of Market Analysis to ensure we are aligned in our latest trade requests. Lastly, to ensure alignment with current research, we commit to maintaining up-to-date reports on all holdings. In this fast-paced environment, we are committed to staying up to date on the market trends, and historically, the Smile Fund has been successful in choosing quality stocks. Thank you, and I will open the floor to questions. Yes.
So I know that you've shown us the graph and you said it really quickly. You're going to rebalance consumer staples and consumer discretionary? Are you all, I'm sorry, because we get black and white copies. We don't know which is
Yes.
green, which are red.
Go ahead. Dylan would ask this question since he's making the trades.
Okay.
Mic issues today. Yeah, so we already processed the trade request on February 2nd. One of the things we did within the consumer sectors is we shifted some of our allocation from discretionary into staples, largely in names like Coke, BJ's, those being the top contributors within there.
So this is after all of those trades. Okay.
Yes, ma'am.
Thank you.
All right.
Danaher is now welcome to the stage to do their stock report.
So hey, you're gonna be up here. So yep, you're right in the you're saying right there. How's this gonna work? Right? When you're you, I'll introduce, right? And then I'm gonna say the main pieces, and then you're gonna hand it to me. Don't work. I don't know how this is gonna work. We'll figure it out. All right, everybody. Do we want to let them filter out first, Dr. H? Or you just want to hit it? Let it ride. All right. Hello, everybody. We are the NICU research team. Today, we'll be presenting the stock Danaher Corporation. To start, our recommendation is an overweight with a price target of $240, representing 11.22% upside. This thesis is supported by a technical opportunity with the stock selling off at 10% last week. The signal here is going to be the bioprocessing inflection, with consumables representing about 8 to 9% of growth, equipment 3 to 5%, with its first positive inflection in the fourth quarter of 2025. Finally, we believe that the EPS guide that management provided in their fourth quarter is actually on the bottom end of what will actually happen. We're going to try to prove today that that the guidance that management provided was in a sense de-risked, and that it is at the low end what will happen in 2026.
Yeah, so to give a little bit of background on Danaher, they are comprised of 3 different segments. The first to go over is biotechnology. Sativia is a acquired company that focuses on the development and manufacturing of therapeutics. Going on to life sciences, a couple examples of some companies acquired is Lika. They're the one of its kind to own the biopsy to diagnostic workflow. Aldevron focuses on DNA technologies, and Paul focuses on fluid filtration. Moving on to diagnostics, Beckman and Coulter does a little bit more of equipment. All of these make up their revenue. You can see by segment. Diagnostics makes up the biggest piece of this, with the revenue mix of majority coming from consumables, which is recurring revenue.
Perfect. So let me walk you through the guidance that caused the sell-off. Management put out my you gotta take that one. I apologize for that. Management put out their 2026 outlook, and across the board, we believe that they're being conservative. Revenue growth at 3 to 6% versus the street's 4.5, right in the mid, which is technically right in the middle. Let's take a look at operating margin, 28.5%, and the street expects 29%. They believe that management's going to beat out on margins in 26. Now here's where it gets interesting. Let's take a look at bioprocessing growth. Management guides 7 to 9% growth, with the street's expectations only at 6.5. So management is actually being more optimistic than consensus on their most important segment. All in all, excuse me, let's keep going. Additionally, life sciences, both management and the street say flat, zero growth. They're aligned on that being a tough segment. But equipment growth is where the disconnect is. Management says flat, 0% growth for the full year. Yet in quarter four, equipment just grew 3 to 5%. And we've known from their disclosures that equipment orders have been up for the 3 consecutive quarters. So if orders are rising and we've just seen a positive quarter, why would you guide to flat for the full year? We believe that they're being conservative. Historically, this has been Danaher's playbook in quarter four. They lower guidance and beat throughout the year. As Barclays put it in their note after the call, when valuations get stretched, investors have little patience for second half weighted guidance. So management anchors low and then beats throughout the year. Okay, so we briefly touched on equipment demand, but where does that actually come from, and what is the key for this in Danaher's revenue blend? This key framework is for understanding why we think bioprocessing is set up well for the next 12 to 18 months. When a biotech company undergoes a public or an IPO and raises, say, $100 million, there's a very predictable timeline for how they spend that capital. At month 0, the IPO closes and the cash hits their balance sheet. In months 3 to 6, they start building out their research capabilities. That's when they're buying lab equipment, things like liquid handlers, analytical instruments, microscopy. That's Danaher's life sciences segment. Then in months 12 to 18, if their drug programs are progressing, they start planning for manufacturing. That's when the big bioprocessing orders come in. They need to build GMP manufacturing capacity. That's bioreactors, filtration systems, chromatography equipment. These are $1 million plus orders. This is Danaher's biotechnology segment, and it's the most valuable part of their business. Finally, months 24 to 36 and beyond, if they get to commercial production, you get the recurring revenue from consumables, the single-use bags, filters, resins that get replaced every batch. That's the annuity stream that makes bioprocessing so attractive. Now, why does this matter for Danaher? Because in 2024 and 2025, we saw a massive resurgence in biotech IPO activity. And you can see it clearly in this chart. This is the biotech IPO deal count and average deal value on a rolling basis, going back to 2022. Look at the trough in late 2022 through mid-2023. Excuse me, guys. Mid-2023, deal count dropped below 10 per quarter. Average deal size fell to 60 to 70 million. The IPO market was essentially frozen because of rising interest rates and the tech sell-off. But starting in late 2023 and really accelerating through 2024, you see the recovery. Deal count climbs back above 15 per quarter. Average deal size goes from 70 million to over 100 million. The capital markets reopen for biotech. Now, if you apply that 12 to 24 month deployment lag we just talked about, those late 2024 IPOs are placing equipment orders in mid to late 2025 and into 2026. The early 2025 IPOs, and there were a lot of them, those orders are coming in the second half of 2026. So the guide for flat equipment growth in 2026 is essentially assuming the IPO-driven demand doesn't show up, or that it gets offset by weakness elsewhere. We think that this is conservative. The capital is there, the deployment timeline is predictable, and we're starting to see it in the order book with 3 straight quarters of order growth. That's why we have a conviction on the equipment recovery thesis, even though management isn't guiding to it yet.
To start off financial analysis, I would like everyone to look at Danaher's organic growth rates compared to their key customers' finished goods inventories. Now, normally Danaher's organic growth rates lead by about a year. This makes sense as their customers are going to use those materials in order to manufacture finished goods. Now, there was a big divergence in COVID. There was a huge demand pull forward, which shot down finished goods inventory and hiked Danaher margins as customers ordered way more materials than they normally need. This led to a process called destocking on the customer end. Now, that's going to be where customers have way more materials and consumables than they actually need for the moment, which is going to slow Danaher growth as they're not going to need to order as much to produce as much. This corroborates Danaher's falling organic growth rate, but rising finished goods inventories. Now, what I want everyone to notice here in particular is going to be the increase in slope, especially for 2025 in finished goods inventories. Now, this could be for a couple of reasons. One very good, one pretty bad. Now, one, sales could have fallen more than management expected, leading for finished goods inventories to increase. Now, on the other hand, it could be management forecasting growth that hasn't quite actually hit yet. Next slide, please. Now, why I believe it's the latter. Danaher's days inventory outstanding have actually decreased despite an inflection in COGS with a sticky growth rate, meaning that they're producing more inventories that are being absorbed faster. Also, their days sales outstanding aren't quite corroborating a timeline where their customers are really stretched for cash with sales decreasing so much that they're building up inventories. Sales are being actualized faster, which can signify fading headwinds in the industry. Now, but what is that fading headwind actually going to mean, and what are some tailwinds for it? So what happens with Danaher and their historical business model is they buy unoptimized companies, which will temporarily reduce margins. Now, as they implement the Danaher business system, which is their optimization system, these margins slowly rise, and they end out better in the end than they were at the time of purchase. Now, as you can see, over COVID, they went on a huge spending spree, spending almost more than they ever have in the past, if not more. This has suppressed margins, and along with the headwinds that they faced, they haven't been able to actually see the benefits from the improved margins via the Danaher business system. As we see these headwinds fade, it's going to be a dual action. We're going to see normal margin expansion, and on the other hand, we're going to see the synergies with these acquired companies come out all at the same time. So we have a improving downstream industry, and we have a clear way that margins can expand. But where can they actually beat on expectations? As Caden touched on earlier, life sciences is most closely linked to venture capital spending, with it being the discovery. Whenever you're going to try and look for new drugs to solve a problem, that's going to be most closely linked to this sector. As Caden talked about mostly, we've seen deal value go up exponentially. And now on the other hand, management is forecasting the segment to remain relatively stable. Now, there has been 3 quarters of consecutive growth. And while, as Danaher says in their Q4 earnings call, they haven't seen the exact orders to justify raising expectations. That's why they haven't. But they are being they could be being conservative in the fact that we've seen all of the early signs of possible expansion in the industry. So while it's not guaranteed, this is going to be the lever that all investors are looking at for them to. And now we see, I want to point your attention to first profit margins. You see that it's fallen every single year almost since 2023, and even before that. Now you see a 60% increase in margins. This is representing that and those increasing tailwinds from their synergies with their acquired companies. And now what I also want everyone to look at is their leverage ratio. For a acquisition and roll-up company like Danaher, this normally fluctuates between 1.5 and 2.5. They're expected to be at a 1.43, meaning that if the industry does not recover, they are positioned defensively, especially when compared to competitors. Or if the industry is actually accelerating like it could possibly be, they're positioned aggressively. They've had a track record of 20 years of acquiring companies and flipping margins to the upside. They could do that in the future and potentially gain market share if the downstream is actually accelerating.
Looking at our risk assessment, we have narrowed it down to 4 main factors. The first being geopolitical exposure. As of June 4th, 2025, the Department of Government Efficiency cut 2,300 academic research grants. Currently, Danaher is partnered with the University of Pennsylvania and Duke University, and they do a lot of research on DNA testing, genetic testing, and they received or saw a total cut of $395 million. Moving on to M&A execution, we put this as a medium probability with a medium impact, as they are so dependent on their Danaher business system, or DBS, their mergers and acquisitions. As we saw, or Evan said earlier, we have seen profit margins also decrease, which kind of goes into my C1 point of margin expansion. From the point of 2022 to 2025, we have seen a 12.35 decrease in profit margin. They really suffer after high levels of M&A activity and struggle to recover. And then finally, looking at our valuation risk, this kind of goes into industry reversal. So originally, probably a couple years ago, it was predicted that during this time, for about 3 to 5 years, there was going to be a dip or lull in spending in the healthcare sector. As of 6 months ago, this has been reversed, and we are starting to see, with advancements in AI, a little bit more capital expenditure.
So for our valuation, we took each segment and projected it out to 2030, and we paired it with the operating margins expansion. Now, for our bull case, what we did was we had aggressive revenue. We also had operating margins returning to their pre-COVID average. Obviously, we did pre-COVID because COVID was an outlier. And next slide. So for our base case, we have moderate revenue moving up to aggressive revenue. We also paired this with operating margins not quite expanding to that pre-COVID historic average. We did this because we think margins are going to get to that pre-COVID historic average, but it might take more than our 5 years projected. Now, for our bear case, we basically did management expectations. So
This is revenue.
this is revenue. This is top line. Segment growth
Top
rate.
line per share? No.
Growth rates. Growth rates.
That's the growth rate in revenues. Okay, got it.
Sorry, I have the percent up that.
All right. Yeah, all right. Now I see the 3K.
Sorry. Yeah. So this brings us to our WACC of 8.756. This is paired with our weighted terminal growth rate of 3.53%. And this brings us to our 25, 50, 25 target price of 240 on the dot, which is 11.22%. Thank you. We will open the floor to questions now.
I've got a couple. I thought the financial statement analysis section was pretty well done, but a couple of things I want to clarify. Keep going, please. Yeah, that's one. Because when I pair this chart with the acquisition history, I'm wondering, where did you get the organic growth number?
So that is straight off of their 10Ks or 10Qs. So I believe that one was quarterly, and they break out what revenue increases were and how much of that was contributed to sales. So I manually subtracted the numbers or added them depending on the price change.
Okay, because obviously 2022, they did a big acquisition. What was that?
That was Cytiva, which was mostly in their biotech industry, which is going to be contributing towards the manufacturing of drugs that already exist.
Okay, and then you see this profit margin collapse.
Yes, sir.
Which I'm trying to reconcile that with, if I'm not mistaken, you show organic revenue growth, don't you?
Yeah, it's going to be, sorry, if were you going to say something?
Well, I'm trying to reconcile. First, the other part of it is, this is an acquisition-based business model. Their leverage ratio has gone down, so they're paying for acquisitions using cash or stock.
Using cash, sir.
They're using cash. Okay. Cash flow then?
Cash flow.
They're not issuing shares. You're sure of that?
In the last couple of years, for this one in particular, I don't believe they issued any shares. It was primarily just an increase in cash. I believe they did issue just a slight amount of debt. And then in 23, 24, and 25, they've actually done share buybacks.
So what's the percent of their balance sheet that's goodwill?
I think so they have 40 billion in goodwill, I believe, and 70 billion in assets.
Something's not adding up for me. I'd like to get some more information from you all, but that was primarily my concern, is her comment about the margin collapse, which is evident in this chart, and the timing of it post acquisition. So I'm sitting there going, if they're resulting in organic revenue growth, why did their margins collapse 150 basis points, it looks like?
So the acquisitions they make tend to have an average EV divided by EV divided by free cash flow of 68. So they just, when I say they buy unoptimized companies, they buy companies that have good top lines and strategic value, but pretty bad bottom line, and then they improve about 2 to 3 years to actually see those implementations effect.
See, that's my point. That's the point I'm making, is that they're buying revenues, yet you all are calling it organic revenue growth. See my point? Something's not adding up. There's a 1 + 1 = 3 here that's not making sense to me, because if they're buying revenues, then you can't count it as organic revenue growth. I would reconcile the numbers, is my point. It's got to make sense, because I don't understand then why the margins would collapse 2 years later. And that's not really, to me. Question is, if you're seeing an explosion of goodwill, they're using cash flow to do this, and they got to do this type of cleanup cycle. What's relevant to me then would be, okay, so they're buying companies that had a very poor cost structure. Is that, and so basically then why is there so much confidence in these long-term growth projections? Because their long-term growth projections means that they have to continue to find companies that fit that category. And the bigger they get, the more difficult that'll be for them to grow. So the question is, can they grow organically or not?
Honestly, I don't think we looked at that thought process at all. And that's something that we need to continue to look into. Evan's asking about, is ROIC going to provide any extra value here on?
Yeah, you can look at it from any number of ways, but I mean, I just think you got to break this down into understanding, if this is their business model, then the bigger they get, the more difficult it is going to be for them to grow. Because they have to do larger acquisitions in order to move the needle the same amount. See, it's a law of large numbers. Yeah.
Do we have any more questions for the Danaher Group? All right, let's wish them well in the competition later this month. Please remember that you can always email me or Hunter Carroll any thoughts or advice for any of the officers or the Danaher team. We'd also like to thank you all for coming and remind you that we are going to have a free networking event at Odd Story on Central. This concludes this ISM. Thank you all.